Hello, I'm Greg Brown. I'm a partner at Cat Mush and Roseman here in Chicago. I've practiced law for 37 years in the employee benefits and executive compensation area. I've had a particular specialty with employee stock ownership plans, or ESOPs. I'm going to try to take a few minutes and give you a brief synopsis of what the tax advantages are for a company which sponsors an ESOP and for a selling shareholder who sells to an ESOP sponsored by that company are. Simply stated, for the company, there are tax deductions involved because this is a tax-qualified retirement plan. Now, where you have a leveraged ESOP, the company can contribute and deduct up to 25% of the covered payroll of the employees who are in the plan, plus the interest payments that the ESOP has to pay on the interest on the loan that has been made to the ESOP either by a bank, the company itself, or maybe with a promissory note to the seller. So that if you have a payroll of $10 million, the principal payments each year can be $2.5 million, plus the interest payments. Now, this is a significant tax event. In addition, if you have an S corporation, that is a corporation that's taxed like a partnership, that is the owners of the business pay the federal income taxes rather than the corporate entity, and the ESOP owns 100% of that S corporation, then neither the ESOP nor the corporation pay any federal income taxes. Now, this is a significant enhancement to cash flow. One more thing, even when you have a C corporation, we can go beyond the normal 25% rule if dividends are paid on the stock that the ESOP holds and the ESOP uses those dividends to pay the debt. This can be useful with companies that have a relatively low payroll in relation to value, many times companies that have big value in terms of intellectual property but don't require as many employees to produce and market their goods to their clients. All of these tax benefits at the company level are of great interest to a lender, and the qualified lenders here really understand this, and it can be an enhancement to the terms of the loan, particularly the financial covenants and, of course, the interest rate. So these are very important. Now, there are also significant tax benefits on the other side for the selling shareholder, where the company is a C corporation, that is a regularly taxed corporation. If I, as a seller to an ESOP, in that instance, sell shares so that immediately after the sale, the ESOP owns at least 30% of the value, and I've held those shares for 3 years before I sold it to the ESOP, and I take the proceeds from my sale to the ESOP, and I reinvest them within 12 months after the sale in what's called qualified replacement property, I can elect to defer the gain on my sale. So if I've got a C corporation where I have a relatively low basis in the shares, which is fairly typical for a C corporation, if I sell to a third party, I'm going to pay long-term capital gains on a significant portion of the sale. Whereas if I take those same shares and sell them to the ESOP under the circumstances that I just described, I can defer the gain. So I can roll over 100 cents on the dollar into qualified replacement property, which in essence is U.S. stocks and bonds. I can defer the gain. This can be a significant income tax planning opportunity. What's more, it can be coordinated with the estate planning opportunities, because to the extent that those shares that I've reinvested in are held until the date of my death, my survivors in my estate are going to be able to step up in basis to the fair market value of the qualified replacement property on my date of death, so that in effect the gain on the sale to the ESOP we're not paying any federal income tax on. That gain and the taxes on it have been foregone. So as you can see, we've got some significant opportunities for both our selling shareholders as well as our company from the tax side in making a sale. Those aren't the only considerations in a deal, but those will get the attention of your client in considering exit strategies. Thank you.